Hello and welcome along to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicol.
And today on the show, we're talking about the great Christchurch catch-up. Now, this is something we have been prophesizing about for a long time, which is that Canterbury house prices would eventually catch up to the rest of New Zealand. Of course, Canterbury house prices have been lagging the rest of the country for a long time in terms of increases, and we've talked about this kind of ad nauseum on the show, that eventually this region would catch up. Now, we haven't mentioned it too much over the last 12 months, and the reason behind that is because it kind of got a good push for a while in the first year and a bit of the podcast running. But we are now starting to see the great Christchurch catch-up that has long been prophesied in our tea leaves and in our crystal balls. And so we're going to talk about what we are seeing right now in Christchurch and why we believe this great catch-up is already underway. Now, what are we seeing in the data, Andrew? Look into your tea leaves.
Look into my... well, this is the part where I can say, I told you so, isn't it, Ed?
No.
I'm not allowed to say that. Okay. All right, fine. Let's just go to hard data. Some of the more interesting months over the last wee while, July 21 and September 21. So in July 21, there was a 4.8% increase, whereas the New Zealand national average was 2.3. So a 2.5% difference higher in Christchurch specifically. And in September, we see the same sort of numbers. So we see 4.9% in Christchurch, 1.9% nationally, and 3% difference. So huge, because in the last 6 months, Christchurch is up a whopping 19%, which is massive. New Zealand up 11.7%. So Christchurch, as a region, has 63% more capital growth in the last 6 months as compared to New Zealand.
And what's important to note, because I don't think you've made a big enough deal about this, Andrew, we're talking about 4.8% increases in house prices per month. That's in a single month. Now, usually when we talk about our forecasting or we talk about, looking into the future at what house prices might increase within a year, we usually say, look, 5% per year. But in July 2021, just gone, almost 5% in a single month, happened again in September. So just quite enormous amounts of capital growth in a very short space of time. Now, we're going to talk about what's driving that in a second, but what I want to do now is say, well, how does that play into the model that we always talk about on the show, about whether something's under or whether something's overvalued? Now, back in late 2020, early 2021, we were saying that Christchurch was 25% undervalued. Gosh, it was low. And we thought, gosh, how long is it going to keep going down for? How long is this region going to be undervalued for? Because, of course, it had been undervalued since late 2014. So only 6 months ago or 9 months ago, it was about 25% undervalued. It's now about 17.5% undervalued by this model. So we've seen a sharp turnaround in fortunes for the Garden City because we have started to see house prices in that region increase at a faster rate compared to the rest of the country. Now, let me ask you this, Andrew. What are economists around the country saying? And what I really want to know is, we've got my numbers here, old baby Tony's numbers here. What's Big Papa Tony saying?
Well, Ed's man
we
crusher
shouldn't call him that, actually. One day he might actually listen to the show and be like, why are they calling me Big Papa Tony?
So what Ed's Man Crush is saying, the Christchurch catch-up looks like it is well underway with various factors now in play, which will cause the national average housing market to flatten by the second half of next year, which will reinforce the catch-up. So to summarise, the rest of the country is likely to flatten, with a few exceptions like Auckland, because he's still big on Auckland. Christchurch and parts of Canterbury will start to heat up, so the catch-up will well and truly be underway by kind of middle of next year. And why does he think that? Well, the Reserve Bank has lowered the amount of high LVR loans for owner-occupiers, and Christchurch is the only major city that is quote-unquote affordable, and so we're going to see a whole lot of young people moving to Christchurch to buy a house, increase demand, that will drive the house prices up. Christchurch, Auckland, they're probably the places you're going to see with the most growth over the next wee while. Auckland's already had some growth. Christchurch still got a long way to catch up.
Actually, do you know what, Andrew? I always thought that argument about young people moving, halfway down the country was not a very good argument. I thought, look, are these young people really willing to pack up their lives and move to a different part of the country just to get a more affordable house? Now, what actually surprised me is it turns out the answer is yes, because I had one of my good friends move down to Christchurch with her husband, probably about 26, 27 years old, specifically decided to make the move because they wanted to buy their own home. They wanted home ownership, and they thought that, hey, that's where we're able to do it. And so I think good on them for making that decision if that's right for them.
And also that given that you've got such a small sample of friends and most of them already based in Christchurch, that's quite interesting.
Now let's talk about what else is going to drive this correction, because a whole heap of the factors that are coming into play in the market which are going to quiet some other regions is the same factors that is going to fuel a boom in Christchurch house prices. So as things like debt to income ratios or tighter servicing restrictions come out from the Reserve Bank, or those higher deposit requirements, it does make Christchurch the one major city where some people are going to be able to purchase. You know, same things happened in 2015. Do you remember when the LVR changes came in, where you needed a 30% deposit to purchase an investment property in Auckland and only a 20% deposit to purchase an investment property right around the rest of the country? Now, what happened? Well, that kickstarted a big old boom in regional house prices, where we saw places like Palmerston North, Wanganui, places like the Hawke's Bay, Gizzy and Wellington. That's when house prices started to heat up, because the restrictions meant that capital came out of Auckland and started moving into other centres. Now, as we start to see those other regions quieten down after their 6-year-long boom, and this big boom we've had over the last 12 to 18 months, we're going to start to see that capital move into Christchurch. So investors starting to purchase there even more, even though the yields are relatively low. Why is that? Simply because that's where they're able to get the lending, because properties are still property prices are still relatively low there compared to some other areas. But what I want to know, Andrew, is, you know, we've got here what the data says, we've got here what Baby and Big Papa Tony say. What are you seeing on the ground in Christchurch? Because I'm still up here in lockdown in Auckland.
I've seen a massive increase to some of the prices that particularly developers are wanting for their product, because, you know, developers price their product. You know, compare that to something on the market where, you know, if it's just a house on the market, you kind of don't necessarily know the price because so many properties are going to auction. You're seeing house prices for huge, like I went to an auction the other day and there was a 3-bedroom unit in three-bedroom cottage in Port Levy, which is around the bays. It's kind of probably an hour drive from the Christchurch CBD, and it's basically a batch. And this thing sold for $1 million. It was amazing, and it was quite interesting because my friend was the listing agent, and someone had contacted wanting to know what the sea level was and whether or not the property was going to be sound for the next 50 years. And one particular water table showed that the property was already underwater. So it still went for $1 million, despite the fact that this probably is a property that may be affected by erosion over the next week.
Well, it's got a saltwater pool, doesn't it?
Yeah, well, I said, you see seaside views, and who wouldn't want to live in the land of Aquarius?
Uninterrupted views.
When you start to see these type of abnormal sale prices, you realise that the heat's really coming on. Couple that with some of the high-end properties. So a property just down the road from me went on the market the other day, and I fired it off to our GM and said, hey, you should have a look at this property. And 4 days after it had been listed and it was due to go to auction, it had sold before he even had a chance to view the property. And like that was a high-end property, which tend to be a little bit slower to move than, you know, your $600,000, $700,000 properties. I had a developer sent me a project today that we said no to, which was some units in New Brighton, and they were talking high sixes, which just seems crazy for their. I mean, look, everything seems crazy when it first comes out, and when you start to get into a boom, and you've got to kind of accept that might be the new norm. But when you look at rents, they're nowhere near where they need to be to sustain that sort of thing. So I think what we're going to see is a lot of people may be investing outside of Christchurch now rather than in Christchurch. Well, you'll still see a lot of investment in Christchurch, but not the same levels. People in Christchurch might start looking elsewhere like Auckland because of those higher yields if they can afford to get in there. And otherwise you lock into Christchurch, and if you can afford the contributions, great, but just make sure that you really do dig into the nitty-gritty, use a return on investment calculator, see what the numbers look like over the next 15 years, because I think the contributions, if you buy at too high a level with a really low rent, will be actually a bit cutting when rates go up.
I think the other thing that I just want to mention is who this episode is necessarily for. What we're not trying to do is create FOMO, like we actually talked about last week, in order to try and say everybody needs to invest in Christchurch now. No, not necessarily. As Andrew said, you've got to weigh up the rental returns, which are looking a bit shaky in some instances. Of course, you'll always sometimes be able to find a good deal as well. But the reason I really wanted to point out the great Christchurch catch-up is that so many investors, both listening to this podcast or watching us on YouTube or whatever, have decided to invest in Christchurch because we said, hey, there's going to be a boom there in the medium term. And it's really kind of gratifying to see that, hey, that's actually happening now. And there are going to be a lot of investors who have taken action, in the face of kind of flat house prices in the Garden City for a while, who are now going to do really, really well. And if you think just in the last 6 months, a lot of people listening to the show, and even myself, I'm not looking month by month at how much house prices are going up in a particular region, but to look back over 6 months and say 20% over the last 6 months, hey, go on homes.co.nz. You've probably done very, very well. So if you've made that decision based on those numbers, thinking, hey, there's going to be a boom at some point in the future, then hey, that's probably really good that you're saying, hey, I'm starting to see the returns of that now.
And I think this is a good reminder that a good investment isn't necessarily in the place that's booming right now. It's in the place that's flat. It's the area where there's good supporting evidence that there might be some growth in the future. You don't want to invest where everywhere's jumping up, because you've missed that jump. You want to make sure you're looking at the kind of the data around, okay, well, how does this sit compared to its long-term average? And that's something that when we're choosing investments for ourselves, try and identify. So I think that's a really good lesson for investors.
Now, let's wrap it up there, but let's just acknowledge the great Christchurch catch-up, and I expect that this will probably continue for the next somewhere between 2 to 4 years, that we're going to keep seeing those house prices increase. Maybe not at the same rate that we're seeing right now. It's not going to be 20% over 6 months forever and ever more. Hey, that would be totally unsustainable. But what we do expect to see is some faster than average growth in those house prices over the next 2 to 4 years. So if you're already in Christchurch, hang on. If it's the right decision for you, because there's potentially going to be some good capital gains there. Look, let's wrap it up there, but please don't forget to rate, review, and subscribe to the podcast. It really does help us get the message out to more people. And hey, if you want to learn more about property with Andrew and I, check out our YouTube channel, because every Wednesday we're releasing a brand new video, teach you something new about property investment. You can find that, just Google Opus Partners YouTube. It'll be the first thing that comes up.
Told you so.
Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicol.
And we're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the property market. Until next time.